Welcome back to our channel, Living on the Ohio River. Hi, I'm Carrie Henshaw from Key Associates Signature Realty. And if you are new to our channel, make sure you tap that subscribe button and give me lots of thumbs up if you like the content that I do. It helps the algorithm. And again, I am a local realtor, so if you are relocating to the area, I love to do these videos, but more importantly, I love to sell you houses. So reach out, text, call, email, whatever it takes. I'm here to help you. So we're gonna talk about interest rates. I am gonna go through an article, when will interest rates really start to matter? It comes from a wealth of common sense. Like, who cares about interest rates, right? We don't care, no, not a big deal. We can throw away the loans, no, don't worry about the houses. Interest rates don't matter, right? No, that is not true. And I'm gonna go through some numbers too around just our housing here locally. Also go through this article, which kind of goes around just how interest rates are affecting the economy as a whole. So not just housing, the bonds, the stock market, what everybody's looking at in regards to what interest rates are affecting us. So here we go. So we're first gonna go to, like I said, I'm showing you the article as you can read along with me a little bit. When will interest rates really start to matter? Here's what the article says. For the longest time, pundits predicted interest rates would go higher, yet they did nothing but go lower year after year. Well, surprise, COVID hit. What do you think they're gonna do to get us out of honestly, we were heading toward the recession before COVID. Who knows if it was even planned knowing the world we're in. But COVID obviously was another thing where they kept the interest rates low, and then we were in this housing craziness, right? Where bidding wars were out there, we didn't have any supply, so not that we're not there yet, but thank God that is over, because that was not a fun time for a real estate agent. It wasn't a fun time for the buyers, and honestly, sellers, it was great for money, but I don't even know if they enjoyed the craziness that was around their own houses. So we're gonna go in and talk a little bit about this as well. So then when rates hit zero, and when they mean zero, that's actually what the banks can buy from the government, it seemed like everyone assumed we would experience lower rates forever. Yeah, right, like forever. Do you not remember when they were 13%? There's nothing that stays zero or low forever. Every 7 years, economies change. I'm not gonna say that's exact, but they go like this. What comes up must come down. What comes down must go up. That is what we live in. So they're not gonna be there forever. And whoever thought that was crazy. And if you've been in real estate long enough, you do agree with me, which I've been in 20 years. Just in time for rates to rise higher than anyone thought was possible in such a short period of time, was the quote. That's what they're talking about this past year, when we used to have 3% and now we're almost up to 7%. And is that affecting us? Of course it's affecting us. Is it slowing some areas down? It is slowing other areas down more than others. I'm seeing some different slowdowns, mainly different price points here at the local area, but it is affecting us, and that's not only affecting us from housing, it's affecting us from everyday living. It's affecting the stock market. You know, inflation is changing the way people are doing things and how they're buying, so it does matter. So it goes when it comes to the markets. Here we go. When rates first began going, it seemed like it was only a matter of time before the Fed would break something and ZIRP would be back in our lives in no time. But a funny thing happened. Rates went up extraordinary amounts and nothing really broke. Not yet anyway. Now, do you really think there's nothing broke in our economy? I'm sorry. I mean, things are doing well, but we have inflation out the wazoo. People are definitely living on credit longer than they ever have. And that's not for the luxury items in their life. That's for groceries and living, things they need. Housing, you have people not trading up because they can't afford to basically get the same house or less house for the same monthly price. So you got changes there. And just everything of living is definitely changing. So I'm not saying that we're perfect, but are we broke? Well, there's definitely things broke in our economy for sure. And time will tell how bad it really will get. And one point that along this way, when we're talking about the markets, I'm definitely starting to see, and it's not really interest rate related, but just signs. I'm seeing a little bit more foreclosures that come into the market, and probably from the moratorium. You think about during COVID, you know, the banks could not foreclose on these homes. It takes a year to a year and a half for banks to foreclose sometimes. And if you were on a moratorium for a year, Well, when do you think you're going to start seeing them? So there are some of those that people didn't pay up for a year and potentially are starting to see those. Second, I'm actually seeing a short sale. I haven't seen a short sale since I did short sales back in 2008. That is another sign. Obviously, there is things that are putting pressure on our economy and people are having a hard time. Now, can they sell and get more out of their money quicker? Potentially, yes, but it depends on condition, how much they've kept, how far they're behind. There's a lot of various things going on. But there are signs that there is some issues out there. Is it gonna rain? Is it gonna pour? Maybe not, but it is trickling. And just things that I look for. So I'm keeping going down there. It goes, here's a look at current US government bond yields. I mean, they're basically stating these are all sorts of crazy things going on here when you consider how inverted the yield curve is, the speed of the rise in rates, and the absolute level of yields that we have seen, at least on the short end of the curve, in decades. So they're claiming they're climbing. Well, of course they're climbing. They are chasing the Fed. The Fed's raising rates. They're gonna be heading the same direction. And so that makes a big difference in our economy and makes sense to why that would be happening. So when is it all going to matter? Well, you know, I don't have a crystal ball. I can tell you some interesting facts, and I actually wrote some things down. I kind of wanted to look at what interest rates were doing, maybe even different price points. And I looked at the 2022 numbers, and again, it was $27.91 roughly in homes that sold in that era, all of one particular MLS, versus 2,334. That's how many homes we're looking at January to today. I then broke it down and I went and looked at everything basically over 700,000. And of 700,000, I was kind of shocked. We actually had, and I have all kinds of numbers here. We had we had 7 homes last year over that price point sale. This year we had 19, which kind of shocked me because you would think interest rates would be affecting that. But then when I went into the numbers, 45% was cash. So we have cash buyers out there which aren't going to be affected. And honestly, I didn't even go into the details to look, but they may be even getting better deals coming in with cash because things are sitting a little longer and not moving as quick because of the interest rate. So I didn't dig into that fact. I do not know that for sure, but something that is interesting. But I did go in and look at what area is getting affected the most. And it's basically the 300 to 600,000 is what the 450 to 600,000 went from 98 last year to 83 homes sold this year. And then if you go in from into the 250 to 450 range, it went from 712 last year sold to 667. So some big number drops really between that 250 and 600 mark for our area, if you're wondering, with regards to price ranges. So a lot of that could be interest rates and first-time home buyers out there that don't want to really take the plunge. A lot of it could also be that trade up. You know, people aren't putting the houses on the market because the trade up isn't getting them anything with the interest rates compared to them being at 3%. So a lot going on, but I thought that was an interesting thing to look at from the housing perspective of what's going on with interest rates here. So there are 3 areas of the market and economy that I have this very same question for. They say, when do rates begin to matter to the stock market? They were making a comment that nearly half of Vanguard investors actively manage their money over age 55, held more than 70% of the portfolios. In 2011, 38% did. At Fidelity, nearly 4 in 10 investors aged 65 to 69 hold about 2/3 or more in their stocks. So we're talking about an old portfolio, which kind of surprises me. Did they not forget about 2010? I think, I could be wrong, and it just says, and it's just a baby boomers and taxable brokerage counts at Vanguard. 1/5 of investors 85 or older and nearly all their money in stocks, up from 16% in 2012. The same is true about 75 to 84. So obviously the older crowd is definitely investing and putting their money in the stock market. My guess is they probably see bigger returns, especially with interest rates, than in the housing market, and why you're seeing such a big plunge into the stock market. Now, what comes up must come down. I don't follow stocks, no expert in stocks. You know, I read articles and everything else. We will see what happens and why there are reasons for the drifting higher in stock ownership than maybe housing in the past, but I do know that when that bubble hit back in the 2008 timeframe, you definitely saw a big change in the stock market going down. So maybe they forgot, had bad memories. I don't really remember, but I remember hearing all kinds of stories back then about the stock market holders. And so not sure exactly what the reasoning is, but my guess is quicker returns and higher returns over a shorter amount of time than potentially housing was over that time frame. So a lot of things going on. Let's see, let's go in. Let's see. Some people likely need to take more risk because they didn't save enough. That would be another reason people are saying it. Older investors have been through more bear markets, have seen the benefits of investing. That's what I was saying, over the long run. So they can probably see the ups and downs over the time. So they're putting more money there, especially when it was down. Today it is the opposite. You can earn only 5.5% in the 3-month T-bills right now. That's the highest level since early 2001. Short-term yields haven't seen above 5% since 2007. So kind of strange things happen in this market. I don't know that I have an answer. Are we being affected by interest rates? Well, I think yes in the housing market. Economy in regards to stock markets, yeah, I would agree so. It's coming if it's not here today, but I think there's a lot of signs that things are broken, but we aren't perfect. And will the government be able to finagle whatever they do with our interest rates and the things they do to move things around to get us out of this inflation and keep us moving forward? So, you know, the big thing that matters with inflation, especially when you have a lot of governments that are giving up the dollar, and that means it's washing up to our shore, right? When it washes up to that shore, that makes our inflation go up personally here locally. So a lot of things going on around the US, around the world. Time will tell. We got a few more months. But we're not doing too bad here in southern Indiana, since we're talking southern Indiana, in the amounts of housing, interest rates. Yes, we're down about 20%, but not doing too bad. And you saw the price ranges again. 250 to 600 is where the impact is. High-end homes, they're not affected. So interest rates not hitting too bad on the 800,000 and above, which you would be surprised. So keep watching. I will keep reporting as we proceed, as the year goes on. And until next time, I'll see you then.
We open doors in realty. Key Associates. Key Associates.